As per the GDP advance estimates put out today by the government, the Indian economy is expected to grow at 9.2% this financial year. It's slightly lower than the RBI's forecast of 9.5%. The real question, though, right now is what is going to be the impact of the Omicron surge and the third wave that India is currently witnessing. Now, most people are saying, most experts are saying, this is likely to be a sharp and relatively short surge where we will see a large number of cases, perhaps not too much of a strain on medical facilities, and it may ebb fairly quickly like it did in South Africa and in some other countries. But the real pinch to the economy comes when there are restrictions, and the restrictions have started to show their impact. Whether it's weekend curfews, or whether it's night curfews, whether it's some restriction on travel, curtailing the number of people who can go to restaurants and other public places like that. In some states, we also have a shutting down of public places and shops and malls and other such areas where people gather. But this also severely hampers economic activity. So what really are we looking at this point? Are we going to end the financial year with Q4 being a bit tepid? And will the exuberance of Q3 kind of make up? To get a sense of what we could expect as the impact of COVID-19, I'm joined now by Kaushik Das, who's the Chief Economist India at Deutsche Bank. Siddharth Sanyal, Chief Economist and Head Research at Bandhan Bank, is with us on the show this evening. I'm also speaking with DK Joshi, Chief Economist at CRISIL. Gentlemen, welcome to all of you, and thank you so much for speaking with us this evening on the India Development Debate. Mr. Das, let me begin with your overview. How deep do you think the cut will be from Omicron?
Hi, Tamanna. So we have a 9.5% growth target for FY22. We have not changed anything as of now because situation is pretty fluid. But I think CSO came out with a number today of 9.2%. I think that factors in to some extent this third wave. Otherwise, probably they would have given a number of 9.5, somewhere close to that. So the CSO number should be seen, I think, partly reflecting the impact of the third wave, although they will also not know how deep the things can become negative with the restrictions and other things that will come in surely over the next few weeks. Now, as you said, October, December should be a good quarter. About 6.5% growth we should be able to get out of that quarter. And July, September was 8.4, which was higher than what people were expecting. Now, if you look at government consumption during October, December, government has spent a lot. We have had non-oil, non-gold imports increasing at 38% YOY, which means that investments will be pretty strong in October, December. So October, December was looking promising. So it could be higher than 6.5 as well. So it could make up for some extent of slowdown in January, March that is expected. But the bigger point is, we just look at GDP data and try to assess the hit. There is a big informal sector in India, and not all part of that pressure or stress is reflected in the national accounts GDP data. So we have to keep that in mind, that the informal sector has been hit badly in the last two waves, and they'll be hit as well in this wave, and a large part of that may not get reflected in the GDP data. So you might feel that the hit is less compared to the last two waves, but the informal sector could still be suffering. So that's something which I think the policymakers will keep in mind while deciding on the budget or monetary policy considerations.
Let's take a look at what is happening with restrictions. So, for example, the Delhi government has now said non-essential stores can be opened every alternate day. You already had West Bengal shutting down some non-essential businesses, so your spa, salons, movie halls, etc. What is the cumulative impact of all of that, Mr. Joshi? Because even in places where there aren't restrictions, people will surely be hesitant to come out and visit non-essential places, especially when the disease right now is spreading like wildfire.
Well, you are right. I think if you look at the GDP data today, let me give that context and then I'll come to answering your question. If you see from the demand side, what has suffered most is the private consumption expenditure. in 2021-22, even with 9.2% GDP growth, the private consumption expenditure is still below the 2019-20 levels, below the pre-pandemic levels. From the supply side, the contact-based services which you were referring to, I think they have suffered the most. The trade, hotels, restaurant, I think hospitality, this segment is GDP is 8.5% below its level in 2019-20. So clearly the first casualty of any containment measure is the contact-based services. And I think so what will happen is that in every wave, they have been hit quite hard. And I think in this wave also, they will be hit quite hard. As far as the lockdowns are concerned, I think the learning from the first two waves is that progressively, I think we have learned to live with the virus to a great extent. And there'll be calibration of containment measures depending on what kind of pressure there is on the healthcare system. It will vary across different regions. And I think in this calibration, they will try to minimize the impact to the businesses. And I think fortunately, the news is that it's not a very severe illness that the virus is causing. So as a result, I think the authorities will be more tolerant towards, I think, towards keeping as many parts of the economy open as possible. Only when there is a surge, I think we could see some containment measures. I think in nutshell, the impact on contact-based services is it's going to be quite pronounced even in the last quarter of this year.
Yeah. No, so already I would say for contact-based services, the peak period of the year end in the end of December was marred by the number of cases that had begun to rise. And the interesting thing here, Mr. Sanyal, and I'd like you to weigh in on this, that all governments, state governments, administrations are saying that they don't want to restrict economic activity. But in practice, you see new rules coming up almost hourly, which are sending the message of broad restrictions, at least in top cities where this kind of consumption is higher. How do you see that impact playing out?
Absolutely. That's a very, very pertinent point. And the way we see it, I agree to a large extent with the points Kaushik and Dr. Joshi mentioned. So very clearly, you will see, we have seen in the last few months that the headline GDP numbers, etc., are relatively buoyant, and there had been an element of exuberance which is floating around. We don't tend to agree completely with that, because there had been a lot of areas where the situation is slightly more concerning. And this particular situation will actually make some of these segments a lot more vulnerable going ahead. So there has to be continued policy support going ahead for a few more months, both from the side of RBI, but more so from the government point of view of government and some of the state governments that need to continue. Your point is very valid, Tamanna, that the continuous change in some of the rules, restrictions, etc., is bound to create huge uncertainty on the part of consumers, on the part of businesses, on the part of my planning for maybe a vacation 3 months down the line, everything. So there will be a natural tendency of pushing down some of the things. In terms of headline GDP, maybe for this particular quarter, we'll lose maybe 0.5 percentage point or even less than that. And that will mean an impact on the over a full year's GDP number just by about 15-20 basis points or not more than that. But I think the damage is more than just the headline number. This will create some bit of further damage to the consumer confidence, which in the latest round was showing the first time after several months was showing the sign of inching higher a bit. The way we look at a lot of indicators these days is not necessarily a year-on-year growth. We try to see that where this particular indicator was in the pre-COVID period in 2019, and on that basis, most of the indicators haven't really surpassed their level that was there 2 years back. So it's not a hunky-dory situation, wasn't hunky-dory situation even without Omicron, and this will definitely be another headwind.
And we're entering our third year really of living with the virus. But the fact is we've not really learned how to live with the virus. When a new variant comes along, we go back to the same protocol, which includes one way or the other restrictions. Dr. Joshi, I want your take on the impact on consumer sentiment. What we've typically seen post every wave is a sort of a bounce back of consumer sentiment all of a sudden, and that surge. Do you think we'll be following that pattern?
Yeah, absolutely. I think, see, what happens, as Mr. Sanyal was saying, the uncertainties on the containment measures and even about the waves, I think they dampen consumer sentiment, and they also dampen investment sentiment because of the uncertainty that it brings in. And this typically kind of delays the investment cycle. Now, as far as I think the consumer is concerned, I think consumer is kind of adapting to the situation in the sense, I mean, there have been the change in the way people consume a lot of goods and services, I think. So that is going to continue. But the as I said earlier, the contact-based service segment, I think that the sentiment there will weaken much more. I mean, and not so for rest of the economy. So clearly, we will see the sentiment also follow a wave pattern. I mean, when as was being pointed out, the RBI's most recent survey on consumer sentiment showed that it had started picking up after the second wave, and now I think it will again get dampened. And it is, I think, the interesting point is that it is still below 2019-20 levels. I mean, so the level of consumption as well as the sentiment is below that, and even future expectations are below that. So that is a cause of worry.
Yeah. We talked a little bit earlier in the show about policy support. Mr. Das, I want to come back to you on that. What kind of policy support can we expect from the Finance Ministry in terms of our fiscal deficit projections and from the Reserve Bank?
Okay, so we have the budget coming up on 1st February. So last year, if you remember, the budget was done before the second wave, and nobody expected that kind of a sharp, virulent second wave that we saw in April, June. So, this time around, we are already seeing the third wave before the budget. I'm sure, a lot of thought process will go into making the budget in such a way that you keep some buffer for any kind of, relief measures that will need to be announced at some point of time, maybe in April, June, after assessing the whole situation. So our broad take is that if the budget deficit probably could have been brought down to 6% of GDP, the centre's budget deficit, from about 6.8 or 7%, that will be the case in this year. Probably the government would want to keep the fiscal deficit a bit higher at 6.5% of GDP to, kind of factor in higher costs for some relief measures, targeted, support for medium, small scale enterprises. And obviously there would be continuous expenditure related to, vaccination, right? So there's a booster which is starting from 10th, and that probably will be extended to the other parts of the population beyond the 60-year plus. So all those costs will be associated in the budget. Plus, the government probably would also like to put a thrust on capital expenditure, like they have done in this year. This year's budget allocation was 30% higher than the previous year. And we would expect that the government would continue to push capital expenditure, because that has a good multiplier impact on jobs, and so that kind of support will be there from the budget. As far as RBI is concerned, the next policy is on 9th February. We think RBI will maintain their accommodative stance, not want to change anything at this point of time, and then go into the April policy and take a call what they need to do. And they could obviously give targeted support through liquidity measures to the sectors that need at that point of time, or maybe in February itself. But rate normalization that we were seeing through the last 3-4 months can get delayed a bit to April. And we are expecting that the virus will peak by February. And by March, April, it should start. By March, it should come down to reasonable levels, so that by that time, April, RBI could think about continuing with the normalization. So support for the time being, keeping the medium-term view in mind for the next 6-9 months, at least from the budget point of view.
When you say support, Mr. Das, do you foresee the return of tools like moratoriums, especially for businesses in the contact industries that have been hit?
Unlikely. I mean, you'll not get a broad-based kind of, kind of support the way we got in 2020-21, because as Mr. Joshi mentioned that we are learning to live with the virus to some extent. People are adjusting their work ethics and how they run their businesses after having learned in the last 2 years what kind of disruptions can happen. So I would not expect a broad-based support for everybody like it was done in 2020 and to some extent in 21. So the level of support will also come down, but not to the extent where you could say that things are okay, so we can pull out some a large part of the support. So everything would be still kind of pointing towards supporting the needy and the small scale, medium scale enterprises and the informal sector in whatever way you can. So that kind of a support, but not a broad-based moratorium for everybody. That is not what we foresee at this stage.
Okay. Mr. Sanyal, give us perspective of where the pain is located. So far, the horrific numbers that we're seeing is restricted to a few states and the large cities. And hence, the restrictions in terms of curfews and night curfews are also being put out there. This time around, what do you think is going to be the impact on the rural agri-economy?
Oh, well, even if the disease is concentrated in bigger cities and in a few states, when the logistics, connectivity, etc., takes a toll in terms of additional restrictions, the economic impact actually often is much more in case of the rural economy as well. For example, in some of the cases, including where right now I'm sitting in the city of Calcutta, I can tell you when the which we call the local train services or the suburban train services, when they got stalled, it becomes very difficult for a small town, trader or a business person to get connected with the bigger town. Becomes very difficult to stay connected with his logistics chain, both for inputs and output. So all these things, even though the disease is concentrated in bigger cities, the impact spreads really, really fast. And the difference here is, in case of smaller towns and villages, typically businesses are run, or at least a lot of businesses are run not on very deep pockets. So you survive once, you survive twice, but it becomes a lot more difficult to survive for a third time. And there, even if the impact is for a shorter duration, just for 2 months, and the virus-related disruption starts coming down at that point of time, but many cases what happens is that the actual disruption on some of the small businesses in terms of it's even to some extent to the extent of its viability, you actually figure it out 3 months, 4 months, 6 months down the line, and it becomes some kind of a shock. And I think we are still figuring out that kind of shock for wave 2. And this particular thing will actually lead to another very significant blow to that overall process.
Yeah. We spoke a little while earlier about what could be seen in budget this year in February. Dr. Joshi, you want to weigh in on that?
Yeah, I think there are a couple of things. I mean, first thing that the budget needs to do is, because it's a health care issue, so I think the allocation to healthcare will have to be generous, because the virus is dented but not defeated, I mean, very clearly. So that's number one. Number two, I think the budget will have to take a very calibrated approach to reduction of fiscal deficit and debt over the medium run. So I think that will give them some space to spend more, particularly for spending on infrastructure, etc. And I think as far as my sense is that this is high time that we extended support to urban poor as well, because the contact-based services, 2/3 of these are in the urban areas, and they are the ones which are getting hammered again. So I think maybe some sort of support would be required because their ability to withstand continuous onslaught of virus, wave after wave, I think is now lower. So clearly that kind of support might come forward. And rural economy is not doing that, is not in a great shape, because that's the reason why government increased the Narega spend a couple of months back, and also I think tried to try to give some more free food grain to the poor. I mean, so that's the indication that things have not normalized. So rural Narega support will be very critical to me. And then finally, I think on the investment front, the government will have to focus not only on increasing the allocation of funds for infrastructure, but also ensure that the projects are executed, because the lack of execution capacity is also showing up as a bottleneck right now. So I think these are some of the things which budget will have to consider.
Before we wrap, Mr. Sanyal, your comments on expectations from the budget?
Yes, to some extent, I agree with the other speakers. But very clearly, my sense is that in 2020 and to some extent in 2021, the focus was to provide some immediate relief in terms of for the absolute bottom of the pyramid. Now, I think gradually you have to actually extend the benefit in a slightly more structured and with a medium-term focus. So, as Dr. Joshi mentioned, that if you actually start allocating some amount of money to some of the projects and capital projects which actually involve or generate some bit of support to the employment scenario, I think that's very important. Narega has played a significant role over the course of the last 18 odd months. That will very clearly be on focus, and nobody can deny the merit of that in this kind of a scenario. But my sense is that we might have to tolerate and withstand with a slightly elevated level of deficit for some more time, maybe for one more year, because we need that particular multiplier to come and support the economy at this stage, rather than being adopting a very hawkish stance fiscally.
Absolutely. This is turning into a long game. We've read and heard about the symptoms of long COVID. The economy seems to be suffering them as well, as we see waves upon waves. Hopefully this one will not have a huge human impact. That is what the projections are right now. But we have to see what the economic impact turns out to be. Thank you so much to all of you for joining us on the show this evening.